Hello and welcome to this week's episode of Nucleus Investment Insights. Today we'll ask the question whether the credit crunch tsunami is about to strike. March US credit data, which covers several weeks post the Silicon Valley Bank episode, shows a precipitous fall in lending. During this time, the speed of change is greater than what we saw post Lehman Brothers in 2008. This demands a serious look at what might be going on in this part of the economy and what it tells us about the current state of play. Today, as always, we have Damien Klassen, Nucleus Wealth's Chief Investment Officer, and we also have David Llewellyn-Smith, Nucleus Wealth's Chief Strategist. Dave, welcome.
The same room for change.
Yeah, this is good. You guys are like looking pretty cozy there.
Yeah, not so squeezy, Sam.
My name's Sam Kerr. I'm the Senior Financial Advisor at Nucleus Wealth. Just a reminder, the information in this podcast is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com and you can book a call with myself or one of the team. We are live every Thursday at 12:30 Sydney, Melbourne time. So jump onto the Nucleus Wealth YouTube channel and you can ask any questions that come to mind and we'll do our best to answer them during the show. You can also follow us on your preferred podcast platform as our show is available on all the majors. So Damo, I'll hand it over to you to lead us away.
Yeah, so, obviously this is, version 4 of the credit crunch, 5, I don't know what to, but I think there's, our first initial look was really about the banking crisis. And what we've really been focused in on now is, our view was that, yes, there's some short-term issues within some individual banks, but it's not a traditional banking crisis. It'd probably blow over. The bigger concern was a credit crisis starting. And so we've been quite active in terms of looking at this, it's not credit crisis, sorry, it's a credit crunch. And what I mean by that is that lending takes this sudden slowdown. And what we see is that we see companies no longer being able to lend as freely from banks losing deposits, pulling back on lending, and that sort of slowing down that real lifeblood of the economy. And so that's where, that's what we're really quite hyper focused on. And the issue we've got is that, we've started tracking a number of different stats and a number of them look like they're turning down way faster than what we would have thought. So it's still early days. So, there is still a chance that, this is all just spurious and it'll all pull out and everything will come good, but it sure doesn't look like it at the moment. And, none of the data is headed in the right direction. But with that, so maybe we'll head across to Dave just to have a look at some of the initial charts.
So, just to quickly recall, in mid-March, Silicon Valley Bank experienced a bank run very swiftly and was rationalized by the US authorities, and a number of other small regionals followed suit in the days after. And so the question we began asking then was, will this result in credit falling to the US economy? And so, we don't get all of the data for that period for months even, especially impacts on lending standards and stuff. That takes until May. But we do get weekly updates from the Federal Reserve on raw lending numbers, which give us a bit of a read on, what the immediate impact of the crisis has been. And that's been showing up in two dimensions now. Firstly, the deposit run, which was very focused on small banks, ran pretty hard around mid-March, but then began to diminish into the end of March.
So it's rate of change, so it's still falling,
It's still falling, absolutely, but
fell
falling,
off a cliff, and now it sort of seems like we're going down the stairs again.
Falling more slowly. And in fact, large banks have been experiencing deposit outflows for some time as well. And both sets of banks, even before this panic, we're seeing these outflows because a lot of money is simply departing to find better yield elsewhere with interest rates rising so high. Things like money markets and things where they can get good returns. So what we were really looking at, what came out last Friday was the second week batch of data for lending from the Federal Reserve, and it was pretty shocking. I'm not quite sure why markets have been so sanguine about it, to be honest. It was the largest fall in credit stock in US history. Not particularly large in percentage terms, but very sudden and quite steep. Very focused on the small regional banks, and there's a bunch of charts here showing this. There's one we've got here showing the deposit run, and then a nice long-term chart looking at credit stock for small and large banks.
Sorry, so the deposit one's the top right.
Yep.
Is that one just sort of showing that, and that last sort of red area is showing that the precipitous drop? Yes.
And so, and then in the bottom left is the lending data, which is split. It's just the long-term aggregate quantity of credit split into large and small banks. And you can see that the large banks have basically been rolling over for the last 6 months or so, and lending growth had really stalled. And then the small banks, there's this hook right at the end where for the last kind of 2 years or so, it had been the small banks that had the much higher growth rates in lending as the large banks pulled back, and then it suddenly just hooked over into this precipitous fall in late March. So to give you some idea of how quickly this has happened and the scale of it, I actually charted in the bottom right I did a chart with the 4 months leading up to the Lehman Brothers event, which happened to be in mid-month as well. That was mid-September, versus the SVB, the Silicon Valley Bank event in mid-March. And it's really interesting to note in the Lehman case, lending actually persisted for like another 6 weeks, despite the fact that it was, a much more high-profile and clearly catastrophic event. Whereas this one has had an immediate impact on lending, despite being much lower profile. Now, why this is the case, I can only speculate. I suspect it's because in the Lehman case, a lot of the lending was securities-based. It was off-balance sheet in all sorts of, different vehicles and things that were traded as bonds. And maybe, there was a pipeline of stuff there that had to kind of exhaust itself. Whereas, with the small banks, it's much more on balance sheet lending. And so the impact of deposit runs and curtailed lending was immediate.
There might be some changes as well in policies within banks just to be a bit more reactive to these things as well.
I think so. I think it's such a sudden change that I think, a lot of this is probably things like credit lines to business and stuff too. So, so the scale of it was big enough to be quite concerning. The speed of it was downright shocking. So where was it landing? Can we just flip over the page? Hang on, we're going to look at the drivers. Well, I might just quickly talk about where it was going. Most of the damage was done in C&I loans, that is commercial and industrial, and there was some hit to consumer, largely in auto loans, but mostly consumer was unaffected. It was mostly business lending that got hit, and so that kind of sets us up for a bit of a supply side shock in the US economy if it persists, of course, because we know at the same time that while this bank run's been going on, the Federal Reserve has been offering cheap alternatives to deposit funding through its various lending mechanisms, which is its job. Nonetheless, so far, there has been a balance sheet restructuring with these smaller banks. And it looks like that's getting underway. I simply want to make the point that it's early days and it's possible that it could peter out. But anyway, so if it does persist, we will see something of a supply side shock in the US, which we're seeing in a number of different other measures, which I haven't put here, but things like the small and medium-sized business surveys in the US are starting to show credit is very tight for businesses.
So basically, I think they're saying that I put that in the performance report just today, that the only times it's been worse than the last 40 or 50 years was the 1990s recession and the 2008 recession.
Yeah,
it's worse than any other time throughout that entire 40-year period.
And access is falling fast as well, and timed exactly with this. So you got sort of soft data evidence for both the supply of credit and on the demand side, showing you that something's going on.
And the price as well, they're paying over and above ordinary rates is rocketed as well.
Yes, that's right. So what this is setting up is obviously a crunch in business activity, especially investment, probably payroll as well, when businesses just simply have had their lines of credit cut, or they've got an expansion plan that they were going to fund through a bank loan, etc. All of these things are suddenly in doubt and will be curtailed as a result of what we're seeing, assuming it continues. And so what we'd expect to see relatively quickly is job losses. And that's how this mushrooms then into the broader economy and starts to affect confidence, and then you would see demand start to diminish as well.
And it's a cyclical part of this. So as well, sorry, I guess the self-reinforcing part of this, where what starts as being a bank goes, okay, or banks in total go, oh, we're losing deposits. Okay, we need to slow down on our lending. And then because they're slowing down on lending, now you get more bankruptcies start appearing. Because more bankruptcies start appearing, people start looking at the banks sideways, wondering which one of these is next, and pulling more deposits out, increasing the cost of funding. So then they pull back on their lending even more, and this just it's the opposite of a virtuous circle. What's that? An unvirtuous. I don't know what you're
a doom loop.
A doom loop, yeah,
which we've described in the next page. Actually, I think if you want to flip down. So I mean, once confidence is dented, then you do get these doom loops. Deposit outflow. The banks want to restructure. Lending falls, and then of course bank profits fall, and then the market becomes aware that bank profits are falling, and then so there's uncertainty around the banks, and then you get more deposit outflow, and so you're into first, that's your first kind of doom loop. Then the one Damo's talking about is a second round, where if this credit crunch runs for long enough, then and the economy stalls enough, then suddenly you get the bad loans from stalling economic activity, businesses going under, individuals losing their jobs, asset prices falling, classic kind of recessionary stuff that then blows back into the same banks as bad loans. And so then that can feed on the first doom loop, and then, maybe even having to raise capital, etc., just as their equity is being repriced lower. And so all these things are classic kind of pro-cyclical credit crunch dynamics that have begun in the US. Now, we're not certain that they'll continue. And as I noted before, the Fed's job in circumstances like this is to be as what is described as the lender of last resort. So as depositors have stopped lending their money to banks, the Federal Reserve has stepped in and started lending its money. Now, is this enough to short circuit the deposit outflows and the balance sheet restructuring that the banks are undertaking? I think most likely not. It will certainly be enough. It's certainly been enough so far to help ease the panic. And the media has been playing a role in that as well. Lots of everything's okay. So the deposit outflows have slowed in the small banks, but I don't think they're about to suddenly flip over and say it's all okay. I think a lot of them will be looking to clean up their balance sheets and make sure everything is ship shape, because they're clearly under stress, and the economic cycle is in a bit of trouble. So I don't think the Fed can change that attitude shift, and the credit crunch such as it has been so far is probably enough to make that a point of no return. That would be my best guess, but I'm certainly not certain at this point. So we'll come to some scenarios for the economy and assets afterwards. I just wanted to have a quick gander at is this just contained to the US? And the answer is no. Or is it global? The answer is yes. I mean, we're probably aware that in the initial stages of this crisis, some European stress appeared with who was it first? It was Credit Suisse. Was it someone else first? No, it was Credit Suisse, and then we had a bit of a Deutsche Bank scare, which was kind of direct contagion from the deposit panic and outflows in the US. But more importantly, and more materially for the economy and assets, is that the ECB has also been hiking rates very strongly, trailing the Fed, and so European banks have already been preparing for a downturn themselves now for a number of months, and their lending standards have been tightening, and then they've got their Credit Suisse event, some counterparty risk to worry about, and so they'll be conservative as well and be structuring their balance sheets, shoring them up, lending a little less, lifting standards, and this is already apparent in ECB's surveying of the banks, and you can see that European lending standards are actually already at the levels they were during the European financial crisis. So Europe is trailing the US on this by maybe a quarter, but it's going exactly the same way. I'm not sure that it will play out precisely the same, because I don't really see a sort of typical credit crunch playing out in Europe the way that we're seeing possibly develop in the US. But certainly the case that the banks will tighten, the economy will fall away, and then the bad loans wave will hit them. I think that is likely in Europe. So they'll experience the second wave of what is this pretty typical end of cycle bank event. So it is global in that sense. The good news is Asia is better positioned, kind of trading off the reopening and recovery of China. That said, if we get what I suppose I'm describing as a kind of North Atlantic credit crunch and recession later this year, then all of Asia is going to get hit pretty hard on the trade side. Being very dependent on trade to both the EU and the US. So Asia's not going to come out of it unscathed, but it looks like Asian banks at least are going to be okay. And I think that's certainly the case with Australian banks. Given the RBA has turned in the cycle before it overcooked it too much in its rate hiking cycle, and it's stabilised house prices, which it almost always does when falls exceed kind of 10% or so, and really start to threaten both the economy and banks. The Australian bank funding costs have risen a little, but not much, and not enough for me to bother putting a chart up about it. And so I don't see any kind of out of cycle real problem for the Aussie banks either. Don't get me wrong. If we do get what this credit crunch develop in the States, and I think effectively that turns into a global recession, which is anything under kind of 2% is how I see it. That's sort of commonly thought of as the threshold. Then the Australian economy is also going to slow significantly. I think we'd see at least a per capita recession. And so we'll see the bad loan problem certainly arrive in Australia after so many years of kind of moratoriums and stuff, with many zombies floating around in these economies, and so tighter credit in Australia too, just not like as bad as we will see in North America.
And Australia is also facing the a mortgage reset, cliff that you're not seeing in most other countries.
It is. So don't get me wrong. I do think the Australian economy is going to suffer, and there are other things like cutting of the tax offset that is going to hit mid-year. So there are some nasty blows coming to Australian households, but I guess the thing is, I think as long as house prices stabilise, then we'll largely avoid that first wave of banking stress, and then like probably more like Europe, we'll see the second wave where the economy is, effectively in recession. Even if in Australia they manage to hide it with mass immigration, which is Canberra's favourite trick, it would be bad enough for the banks to be seeing bad loans. So they'll experience that second wave as well.
Over to you, Sam.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
So the next thing we want to do is run through some scenarios for everybody to see, how we see this, our own base case versus, bull and bear scenarios. So, my base case is that this is going to be a material credit crunch in the US. I don't know how material, but material enough. Part of why I think that is, I think the deposit outflow stuff probably continues. And so, the regional banks have got to find a way of stabilising that. And that may just be as simple as paying more for deposits, or finding alternatives to deposits other than the Fed, because the Fed does come with, a little bit of a black mark from markets. Even though we don't see individual banks, they in the data they can sniff out a vulnerable bank, and so we're going to see falling net interest margins for these small banks anyway. And so I think that crunch continues. So I'm just seeing a moderate, pretty classic recession in the US for a couple of quarters later this year. Pick your quarters mid-year or second half, and then the bad loan wave coming as a second hit to the banks. None of this is priced in the S&P, I don't think. I mean, to some extent in the banks, in the smaller banks, it is, but the broader S&P does not have the kind of earnings hit that a moderate recession would represent. In analyst forecasts, it's probably a 15% earnings hit, and we don't have anything like that in analyst outlooks. So therefore the stocks would fall if this happened. I don't pick a number. I don't know how far. But
and keeping in mind as well, they're sort of sitting in terms of valuation size. We're sitting at the top of valuation ranges. So I think it's global stocks are at their 80th percentile of in terms of being expensive.
Yeah.
And so and the only times they've ever been more expensive in the last sort of 20, 30 years is the tech boom and post-pandemic boom. So and both of those had this earnings growth story behind it that at least you could justify saying, okay, maybe I'm paying 20 times or 30 times for earnings, but I'm getting all this growth. Whereas I think that it's pretty hard to come up with that argument at the moment. And so if you saw earnings fall, I sort of feel there's a bit of a point where you go, if earnings only falls 5%, then maybe we can get away with some higher multiples as you look through this next set of growth. But once you get earnings falling 10 to 15, I feel you've got to take some off the multiple as well.
Yeah.
So
I would expect, I think the Fed hikes again in May, and then it'll be done, I would say. We saw US inflation last night. It was definitely more promising than February, cooling on a number of fronts, food in particular. Services were still strong, but not as strong as in a month before. And there are some sort of embedded disinflations coming through in rent and other things. So, and if we did see this moderate recession, I expect basically the inflation problem to be all but resolved. So I'd be looking for bonds to be pretty heavily bid in this scenario, and certainly offer better returns than stocks, even if stocks are helped by falling yields. So that's my base case. But we, of course, we're constantly looking at the alternatives. You want to flip over, Damo, one more? And so the bull case, I think, is, you could call this a soft landing. I would probably still call it a mild recession. I'm not kind of particular about, how you define a recession. I don't necessarily see it as 2 quarters of negative GDP. One might be enough. Might just be zero growth for 1 or for 2 quarters. Who knows, or just very low. But in this case, we would say that the Fed resolves the small bank run, manages to stabilize deposits without them, suffering too much kind of net interest margin damage. But that would force it to hike a few more times, and then to add to this kind of bull case, you need to see inflation continue to come off, even though the small bank stuff is resolved. So that's another assumption you've got to make to get to this bull case. But if you feel like that's the case, then I would say that the S&P falls are done, and nonetheless, I would think you would probably still see some upside in bonds. I don't know how much more upside you could get in stocks. Probably a little if you got some bid into bonds as the Fed finished its cycle, and the economy stalled enough that disinflation becomes the story for the next kind of 12 months or so. So you get a pretty good bid into bonds. And so that's your bull case. I would still argue that you're better off in bonds and stocks in that bull case. But it's probably, at that point, it's becoming a more balanced argument. And when I have a look at the bear case of a severe recession, which I don't expect, but this one is just more of the same, where what we're seeing is a credit crunch coming out of the small banks actually turns into something more nasty, especially, for instance, if certain segments where they're very strong that are in a lot of trouble, like commercial property, turn into really big busts, which intensifies the bank run, and we end up with losing a lot of, when I say a lot, a couple of, it could be anywhere from scores to hundreds of small US banks. I think in the S&L crisis, they lost over 400 small banks. Keeping in mind that there are, 8,000?
There's 4,000 odd banks.
The 4,000 odd banks
4,000 credit unions.
And about another 4,000 credit unions in the US. So we're talking about, an economy that has a stunning amount of, purveyors of credit. And then you can look to a really considerable fall in stocks, and you'd be looking at a return to what we've actually seen for the last 3 cycles, where you had a proper recession in the US, where the Fed actually cut 5% on each occasion, 500 basis points. in which case, the US 10-year, really does crater, and you'd be back to lowflation in the US. Now that bear case is plausible. It's not my base, but it's definitely plausible. I would. What would you have, the bull and bear? Which would you say was more likely?
Here's a bear case would seem to be more likely. I mean, if inflation was 2%, then I'd say, oh, yeah, the bull case is more likely that the Fed will step in and start pushing more money down everyone's throats. But the fact that we've got inflation at high levels, I would say, if anything, the Fed's going to overcook it rather than they're going to err on the side of being too tight with monetary policy in order to make sure they've killed inflation.
Yeah, I'd probably agree with that. So yeah, I guess that brings us to the money shot, which is what happens to various assets.
Maybe, Sam, we'll go quickly to you first.
Yes.
Yeah, just firstly, we've got a question from Wolfers. He's saying it's a great theory, but markets are steadily going up. So he's asking the question, what else is going on?
I would say that the most likely scenario is that people are taking in that the bull case still, and assuming that whatever has happened, that there'll be rescues, there'll be enough that'll solve it. I think what they're missing is this the idea that it's a boiling frog part where the issue is, was there an imminent banking crisis? And I think markets have gone, oh, there might be an imminent banking crisis, we need to be worried. And then they're like, oh no, there's no imminent banking crisis. They seem like they're solving all the problems. We can get back to it without sort of taking into account what's happening on the credit side. And that's the part which, and look, these numbers are still early. Like, we still haven't got full confirmation about what's happening on the credit side, but there's enough there to be concerned and to be watching it really closely. And so markets, I guess, have decided not to focus on that. But I would say that what will happen is, if these numbers continue, then the markets will ignore it for a while, and then all of a sudden start repricing very quickly in a very short period of time.
Yeah, I would add, for the last year or so, there has been a constant battle between deteriorating macro or deteriorating top-down views of what's coming for assets, and positioning in asset markets, which has been, regularly stretched both to the downside and the up, which is really typical of bear markets, where you get these wild swings in psychology and positioning. And for the last month or so, we did, following the initial phases of this credit shock, we had a pretty good sell-off, and then we've had a few weeks of rebound, where markets got oversold, overstretched to the downside in positioning terms. Sentiment fell off a cliff. All of the trend following strategies and algos and CTAs and all these other things that exacerbate the volatility in the market all were incredibly stretched to the downside. And now we're on the upside of that again, and we've seen this cycle 4 or 5 times, I think, over the last 6 or 8 months, as the Fed has keep raising rates. And it's not irrelevant to the real economy. There's pretty good evidence that US retail sales, for instance, track pretty strongly with movements in the S&P 500. So, but you get these bear and bull surges, the underlying economy actually does kind of pulsate a little along with it. But you got to look at the fundamental drivers of what's coming beyond those things. And, if I'm very happy to admit that if there's no credit crunch, as it were, then, stocks may have it right again for a few more months. But if that is the case, then I'm not sure US inflation is contained enough yet either. So you'll see the Fed keep hiking. So again, you'd face that quandary with your bull case, because you're then relying, as we discussed earlier, on the immaculate disinflation, which I think is a little bit hopeful. So, I'd say that the main inputs of this kind of top-down, bottom-up kind of struggle that we've seen. But at the same time, you've got China reopening, which is obviously good for global growth compared to what we had with it, shut down against COVID. And that's given the sort of a whole emerging markets complex a lift. And the Ukraine war distortions have worked out a lot with the energy crisis passing, significantly, not entirely, but very considerably. That's another tailwind for markets. So, it's not all gloomy by any means. But when you sort of weigh the balance of these forces, then, an economy as indebted as the US, even though, it has done some deleveraging in the last decade or so, still plenty of debt. It's a Western economy, a financialized economy, slightly less so than it was, but still utterly credit dependent. And so if you're going to see that curtailed, that really is cutting the oxygen off to everybody. So, that is a critical input that will override these positives if it happens, if it continues to do what it appears is happening. So, there are definitely some positives. It's just that we think that the balance of risks is that they get overwhelmed in due course. I would just finally say that, as Damo says, typically I don't look to the stock market to tell me the future unless I think that future is positive to begin with. Like, the stock market's just not good at discounting risk. It's good at discounting upside risk, not downside. And I think the bond market has a much better history of predicting downturns than the stock market does. And so my final point would simply be to look at the bond curve, which in the US is absolutely howling deep recession and has been for the last kind of 6 or 8 months with an inverted yield curve. And it's got a 100% record versus the stock market that goes up and down like a yo-yo depending on which way the wind is blowing. So, the ballast of those things over the long term suggests, that caution is the better part of valor at this point of the cycle. So just kind of closing out with
sorry, next Sam.
Oh, we're going to flip to Sam here.
Yep.
Yeah.
Before we get to the investment outlook. Yep.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show. So now we have our question of the week. This is for viewers to have some discussion in the comment section over the coming days. So the question for this week is, has the credit crunch started? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. And now back over to you guys for the investment outlook.
Yeah, so I guess we've hinted at what we feel is better placed over the next 6 to 12 months. And for me, it's there's more upside in bonds than there is in stocks at the moment in all of the scenarios that I think are most likely. So we're quite overweight and underweight in that respect. Excuse me. we're basically in Australian government bonds, and we're having a decent run of employment numbers in Australia. But I guess what I'm saying is I do expect the Australian economy to ape the downturns elsewhere, whether it's precisely that or the same or not. I think the direction will be the same, so we're happy to hold those bonds. In Forex terms, I think it's fair to say if we get the mild recession, softish landing scenario where stocks have priced any harm that's coming, and there's more upside in bonds, then in that case, then the US dollar would keep falling and the Australian dollar would rise. So it wouldn't be there'd be, I guess you would say, more or less argue that there was no real reason for a safe haven move in Forex. In the other two cases, my base case, the Australian dollar has been kind of stable versus the US dollar, right, falling against the euro. And the US dollar has been relatively weak, but I do think that if our base case was to transpire and we get an ongoing decent credit crunch in the small bank segment and moderate US recession, I simply don't trust that the US dollar will keep falling. I think the risk of and probability of more bank failures is likely to trigger a bit more safe haven trade into the US dollar. And then, of course, as I've already mentioned, I expect Europe to follow US down in this. So I'm not sure why anyone would want to hold euro as that economy falls apart, even as the ECB overcooks its tightening. So, I'm therefore, I'm more uncertain than I would normally be about Forex in this cycle, at this stage of the cycle, I have to say, just because the US dollar got so high so early, it's been coming down early. So, but I don't really trust it yet. So that has some implications for gold as well. If you're thinking about gold, it's been running riot for the last kind of 6 months. It's been terrific. But I guess what I would say is, if you're looking at gold, I'd be buying dips. I think there's good possibility of significant dips if we see rallies, safe haven rallies in the US dollar. If we see the bear case, then I would say a big rally in the US dollar is a certainty. And so it depends how you see the probabilities of those scenarios playing out. So are there any other? I guess property, I think, is largely bottoming in Australia. I don't think it's about to take off or anything, but that'll take RBA cuts. But I think they will be coming in due course. So I think 2024 shapes as a new year of property boom in Australia, especially since Australia still has relatively strong inflation, but its wage growth is really collapsing, driven by mass immigration. And so on one hand, you've got concerns about a wage inflation cycle with the RBA just dissipating thanks to immigration, and on the other hand, crazy rent rises thanks to immigration. And so that's setting you up for another housing bullish cycle in short order. Any other asset classes I need to cover, Damon?
Well, it's interesting. We had one of the questions from Christian. Has the full impact of high interest rates been realised for non-financial asset values and real estate, including real estate, and for the debt service burden? Which I would probably say no. I think that we're still seeing rises in terms of as fixed rates roll off in countries around the world. Australia, one of those, but certainly once he's looking at commercial property, what we're seeing there is that most of the time the lending's sort of 5 years or 10 years, and so that lending is starting to we're starting to see lending rolling off that's often been refinanced at a lower rate, and And so, yeah, the debt finance burden, for example, for one, is certainly rising in terms of those companies. And so, the full impact, you're going to see. Well, if we're right, it'll be a mixture of. The question for those companies will be really working out which ones are going to be most hit on the earnings front. Because if your earnings holds up, so say you're in a I don't know, let's say some sort of utility, gas pipeline or something like that, and you're looking at that and you don't think there's too much risk to the earnings, which in a lot of cases there won't be, then falling interest rates are often good for asset prices within those. Or if you're in defensive assets like consumer staples like your supermarket goods and things like that. On the flip side, if you're in the assets that are actually going to hit on the earnings front, so to say this commercial property side, is that if we're right and interest rates start falling, that'll be good for valuations, but you might be the epicenter of the whole problem in the first place. So yeah, it's about trying to making sure that the safe assets, if you're in safe assets at the moment, truly are safe, and you're not piling into something where the earnings or the dividends are going to be at risk.
Nice one, Damo. And I just want to let the viewers know there are ways to take advantage of what's going on within our active and passive portfolios. So, for example, with the exclusions that we offer, you could exclude all financials if you're concerned about this, or you can. We have another exclusion. You can exclude all Australian banks. Or you could add in, say, defensive stocks, or add in some quality stocks as well with the additions there. So just wanted to let people know, that's a way they can play this if they think that's the way to go. So that pretty much wraps us up. So thanks, Damo. I'm not sure where Dave's got to, but I'm sure we'll see him again soon. So yeah, thanks for sharing your insights.
Thanks, Sam.
Excellent. So if you enjoy our content, you can subscribe to our YouTube channel now. Click the bell below to make sure you don't miss out on any future episodes or future content. We do put out a lot of other content in addition to this podcast. Our performance report was out this week as well, so you can check that out at nucleuswealth.com. Like the video now, and if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you please share it with them. We do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comments section below, or send us an email at contact@nucleuswealth.com. And if you'd like to look at the slides in more detail, we'll post them in the show notes this afternoon, and you can view these at nucleuswealth.com/webinars. So for myself, Damien, Dave, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.